One of the best indicators to predict recession is called yield curve. And if you have been watching my channel, you know that I have been talking about recession and the tools and indicators like yield curve to predict what's coming ahead. Okay. The worst strategy you can follow is to bury your head in the sand like an ostrich and assume and hope that everything is going to be fine. Okay. That's the worst thing you could do as an investor. We are not ostriches. We are prudent, informed and educated investors. So we always look for these signals, these indicators to understand what's coming ahead. It doesn't tell you the exact timing, but it tells you what's coming ahead if you are a prudent investor. Okay, so what is yield curve? So yield curve is basically the difference between a short-term treasury yield and a longer-term treasury yield. So when we calculate the difference and we plot this over a graph, we get a yield curve. And when this yield curve gets inverted, that is a sign that the economy is actually going through some crisis. So what does it mean it's get inverted? Basically, when we look at the bond market, the short-term treasuries or bonds, they typically yield lower than what you can get in the long-term investment. When you look at the different duration of the bond, the short-term bonds yield lower compared to the longer-term bond. For example, if you buy a 2-year treasury bond, that should yield lower interest rate compared to a 30-year or 10-year treasury bond. Why? Because when you lend for a longer term, you're actually taking a lot of risk, inflationary risk, economic risk. So you should be compensated higher compared to a short-term lending. That's a typical healthy economic scenario. Okay, but since June 2022, we have been seeing that yield curve is inverted, which means the short-term lending rates are higher compared to the longer-term lending rates. So when we look at the US bond market, we can see the 6 months, 1 year, 2-year treasury yielding higher than the 10-year, 30-year treasury yields. Why? Because the bond market that is consists of the smart money, the big money like financial institutions, banks, like hedge fund owners, they're moving their capital towards the longer term treasury. Okay, so the price of the bond and the interest rate are inversely correlated. If a lot of capital moving into the long term bonds, then that means the price of the bond will go up and it will suppress the yield. Okay, so when the yield on the long term is getting squeezed, that is a sign that the money is moving towards the safe haven because they don't see the confidence in the economy, at least in the short term. Okay, so that means the economy is going through a troubled time. So this is the sign we see when the yield curve gets inverted. Okay, so the yield curve has been inverted for the last 2 years since June 2022. Okay, now we are seeing it is getting uninverted. In the last 100 years history, we have seen that whenever the yield curve gets inverted, that's a sign that the economy is going through a trouble. And when it gets uninverted, 9 out of 10 times it has been proven that it precedes a recession. When you look at this graph, you can see those gray lines are actually recession, and whenever the yield curve gets inverted and then uninverted, it results into a recession. Okay, so this time it's not different. Okay, we're seeing the yield curve is getting uninverted. So today, a yield curve of 2-year treasury and a 30-year treasury curve got uninverted. Okay, now this could be an early sign. We have to continue watching it. It may come back to an inversion mode again tomorrow, but if it goes back into the uninversion mode and stay there, then this is the sign that things are changing. Okay, now this is 2s and 30s. We will have to look at the 2s and 10, the 3-month and 10, right? So all of these different yield curves are also very important, but this is going to set precedence. So over the next few weeks or month, we can see if all of these yield curves gets uninverted, this is the moment we should be looking at like a hawk, that this could blow up things in the real economy. And why this matters? Because historically, Federal Reserve always followed the short-term treasury yield, like 2 years. Okay, so if the 2-year treasury yields start tanking, which now is slowly going down, which means the Federal Reserve will actually follow that. They will start cutting rates to follow the US 2-year Treasury. And when that happens, this means that a lot of capital is moving towards the short-term treasuries. Why? Because now these things are getting broken and Fed is going to cut rates, which means everybody is trying to pull their money from the equity market and other economic actors and park their money into the short-term treasuries. So I'm not saying that this is going to happen tomorrow. I'm giving you this information just to keep an eye on it like a hawk. Keep watching it. And when it happens, when it gets uninverted, you know this is a time you have to be very vigilant and move your money from the riskier assets and park in the safe havens like treasury yields, commodities, gold, value stocks, but move away from the riskier assets like tech stocks, like Magnificent 7, S&P 500, NASDAQ. You should be staying away from those assets if this happens. Not suggesting it's happening tomorrow, but we have to be watching it like a hawk. Okay, if you like this video, give me a thumbs up, subscribe, and let me know how are you protecting your finances. If you need any help with regards to professional financial planning, kids education planning, your retirement planning, let me know. I can connect you with one of the best financial advisor industry, and they can give you the honest help. Check the links below. There's some free stuff available for you, so take a look at it, and I'll see you in my next video. Bye. If you are an investor in the US, in Canada, or in Europe, and you are considering investing into Dubai real estate market, this video is for you, because we have a platform called Stake, which allows you to invest into the residential real estate market and start earning rental income right away without going through a lengthy documentation process or coming up with a heavy down payment. Stake is built upon the concept of crowdfunding. So it is democratizing the entire investment strategy and allows you to own a single unit of the entire investment portfolio. So you don't have to own the entire property, right? You can be part of the pool that can actually own a piece of property, a piece of real estate. So that allows you to start with as low as 2,000 dirhams, and you can slowly ramp up. So as you start investing into it, you can not only own a bit of real estate, but you also get a portion of the rental income on monthly basis. So it's a passive investment strategy, diversifying your portfolio from traditional North American or European markets into Dubai, which is hustling and bustling and growing very fast, and allows you to build your wealth over time. So don't delay. There is a link down there in the description. If you click on this, it will give you free 200 dirhams in your account right away to start with, and you can thank me later.